The European Commission has announced the ReArm Europe initiative, signaling a major shift in Europe's defense and fiscal policies. This marks one of the largest military and economic restructuring efforts in recent history. Alongside this, the European Central Bank has initiated a policy shift by lowering interest rates. As Europe directs substantial resources toward defense and security, the resulting economic and financial fluctuations will ripple through various industries, including real estate. Increased government expenditure, inflationary pressures, and potential shifts in interest rates could alter market dynamics in the coming years. These concurrent developments will shape investment landscapes across the continent and are poised to impact Portugal's real estate market significantly. For investors, understanding these macroeconomic shifts is crucial to navigating potential risks and opportunities. Europe is preparing to mobilize up to €800 billion for defense, a move that is expected to have profound economic consequences. Historically, large-scale government spending of this magnitude leads to increased public borrowing, potentially driving up inflation and influencing interest rate policies. The European Central Bank projects inflation to decline to 2.3% in 2025 and 1.9% in 2026. However, the heightened demand for materials and services linked to defense investments could disrupt these expectations. If inflationary pressures intensify, real estate investors must prepare for potential fluctuations in property prices and financing costs. Several key factors will shape the economic impact. Higher public sector borrowing. As governments allocate more funds to defense, national debt levels are expected to rise, possibly affecting investor confidence and interest rates. Increased consumer spending. Government investments in military sectors can create job opportunities and increase household incomes, leading to higher consumption. If supply does not keep pace with demand, inflationary pressures could rise. Energy prices and supply chain disruptions. Military expansion requires vast amounts of energy and raw materials. A surge in demand for commodities such as steel and fuel could drive up construction costs, impacting housing developments and infrastructure projects. While lower interest rates may initially support real estate investments, any unexpected inflation surge could prompt the ECB to reverse course, tightening monetary policy and increasing borrowing costs. The ECB has lowered the deposit facility rate by 25 basis points to 2.50%, aiming to stimulate economic activity. However, uncertainty remains over the long-term trajectory of monetary policy. If inflation accelerates due to heightened government spending, the ECB may be forced to halt rate cuts or even implement rate hikes to counteract inflationary risks. In the short term, this policy easing benefits real estate investors by reducing mortgage costs and improving credit availability. However, the medium-term outlook remains uncertain. If inflation stabilizes, the ECB may maintain a loose monetary policy, ensuring favorable financing conditions for real estate transactions. If inflation rises unexpectedly, the ECB could react by increasing interest rates, making mortgage financing more expensive and dampening property demand. Investors should remain vigilant and monitor ECB policy updates to anticipate shifts in borrowing conditions. Lower interest rates and increased government spending could generate mixed outcomes for European real estate markets. Countries with strong economic fundamentals, such as Germany and the Netherlands, may see heightened demand for residential and commercial properties, driven by greater liquidity and investment inflows. However, nations with significant debt burdens may experience rising bond yields, increasing the cost of financing real estate projects. Additionally, as defense-related industries expand, demand for industrial and logistics properties could rise in key locations supporting military infrastructure and supply chains. Investors should focus on markets with strong economic resilience and strategic growth potential, while being mindful of regional disparities in financing conditions and government debt levels. Portugal continues to attract foreign investors due to its high quality of life, tourism appeal, and tax incentives. However, the evolving macroeconomic landscape introduces both opportunities and risks that investors must carefully consider. Key market trends include lower mortgage rates. Reduced interest rates make homeownership more accessible, sustaining demand for residential properties. Rising construction costs. Increased demand for materials due to military spending could lead to higher property prices and slower new developments. Logistics and industrial sector growth. The expansion of European defense infrastructure may increase demand for logistics hubs, industrial parks, and commercial spaces in Portugal. Strong rental market. A rising number of digital nomads, foreign retirees, and expatriates continue to drive rental demand, especially in Lisbon, Porto, and the Algarve. However, inflationary risks could lead to policy changes, such as stricter rent controls or higher property taxes on foreign investors, which may affect long-term rental yields. Market analysts predict Portugal's property prices will increase by 3 to 5% annually due to sustained demand and limited housing supply. Mortgage rates are expected to remain stable through 2025, but could rise if the ECB tightens policy. Rental yields in key urban areas are likely to stay strong, averaging between 5 to 7%. To navigate this evolving landscape, investors should consider the following strategies. Prioritize prime locations such as Lisbon, Porto, and the Algarve, where demand remains resilient. Capitalize on low interest rates by securing financing before potential rate hikes. Explore alternative investments in industrial, logistics, and commercial real estate, particularly those linked to defense sector expansion. Monitor government policies for potential regulatory changes affecting rental markets and foreign property ownership. Diversify investment portfolios with a mix of residential, short-term rentals, and mixed-use developments to maximize returns. Europe's rearming initiative and the ECB's evolving monetary policy present both opportunities and risks for real estate investors. While lower interest rates provide favorable financing conditions in the short term, potential inflationary pressures and fiscal policy shifts could reshape market dynamics over time. Investors who remain adaptable, secure favorable financing conditions early, and focus on high-demand locations will be best positioned for success. By staying informed about economic trends, ECB policies, and local regulations, they can navigate risks and capitalize on emerging opportunities. As Portugal continues to attract global investors, its real estate market is likely to remain robust. However, the next few years will require strategic foresight and financial prudence to optimize investment outcomes.